There is a profound difference between guessing and knowing. The vast majority of the financial world is built on the art of guessing. Analysts guess what a company's earnings will be next quarter. Traders guess which way the Federal Reserve will lean in its next meeting. Pundits guess whether the market is heading for a boom or a bust. It is a frantic, high-stakes, and ultimately exhausting game of prediction. It's a game that Warren Buffett, the most successful investor in human history, refuses to play. He has built a fortune of over $100 billion, not by predicting the unpredictable, but by understanding the inevitable. While everyone else is staring at the flickering ticks of the stock market, trying to decipher the next minute, Buffett is looking at a different kind of chart, one that moves with the slow, grinding, unstoppable force of a glacier. He is looking at the charts of human history, of demographic destiny, of the non-negotiable needs that will shape the world not next quarter, but next half-century. This is the great secret hiding in plain sight. Buffett's true genius is not in stock picking, it is in trend identification. But not the trends you read about in breathless headlines, not artificial intelligence, not cryptocurrency, not the latest tech disruption. He focuses on the megatrends, the slow-moving, undeniable currents that will carry certain businesses forward, year after year, decade after decade, with the certainty of a river flowing to the sea. He places his bets on what the world will almost certainly look like in 30 years, and he does it by understanding a few simple, powerful forces: an aging population, a growing global middle class, the world's unquenchable thirst for more energy. These are not guesses, they are near certainties. The costly mistake that this philosophy prevents is perhaps the most common and destructive in all of investing. Chasing short-term fads while completely ignoring the massive, inevitable tailwinds that can power a business's growth for a lifetime. It's the difference between trying to catch a firefly in a jar and harnessing the power of the wind with a sail. One is a frantic, short-lived chase. The other is a journey powered by an elemental force of nature. Today, we are going to dismantle this philosophy piece by piece. We are going to provide you with a new lens, a powerful framework for seeing the world, not as a chaotic series of random events, but as a system of predictable long-term trends. You will learn to identify and invest in the companies that are perfectly positioned to benefit from these major multi-decade shifts. You will learn how to build a portfolio that isn't just subject to the whims of the market, but is actively pushed forward by the powerful, deep currents of history itself. This is not about timing the market, it is about aligning your capital with the forces that are shaping the future of civilization. This is the final promise: to trade short-term speculation for long-term certainty, and in doing so, to fundamentally transform your approach to wealth building and secure your financial future. Our journey begins with the foundational principle, the very bedrock of this entire worldview. We call it the principle of inevitability. It's a concept so simple it's almost insulting, yet so profound that mastering it separates the amateur from the master. It is about learning to see the forest, not the trees. It's about ignoring the deafening noise of the present to hear the quiet hum of the future. The quintessential story to understand this principle is not found in a hot tech stock or a complex derivative. It's found in something far more boring, far more powerful, and far more essential to the functioning of modern life: the railroad. For much of the 20th century, railroads were seen as a relic, a dying industry from a bygone era. They were the symbol of the 19th century industrial age, overshadowed by the rise of the interstate highway system and the speed of air freight. Wall Street had written them off as slow, capital-intensive, low-growth businesses. They were, in a word, unsexy. But Warren Buffett saw something different. He wasn't looking at the stock charts from the past 10 years. He was looking at a map of the United States and a projection of its population and consumption habits for the next 50. In 2009, in the smoldering ashes of the great financial crisis, when fear and uncertainty were at their absolute peak, Berkshire Hathaway made a stunning move. It announced its acquisition of the Burlington Northern Santa Fe Corporation, or BNSF, the second-largest freight railroad network in North America. This was no small purchase. The total transaction was valued at a staggering $44 billion, the largest in Berkshire's history at the time. To the legions of short-term thinkers, it was a baffling decision. Why, in an age of iPhones and social networks, was the world's greatest investor making an all-in bet on steel wheels and railroad ties? Buffett explained his logic with crystal clarity in his annual letter to shareholders, and his words are a masterclass in the principle of inevitability. He called the acquisition an, quote, all-in wager on the economic future of the United States. He knew that regardless of which political party was in power, regardless of the next recession, regardless of technological fads, one thing was an absolute certainty. The American economy and population would grow over the next century. As long as people needed to eat food grown in the Midwest, drive cars assembled in the South, and live in homes built with lumber from the Northwest, massive quantities of goods would have to be moved from point A to point B. He saw the railroad not as a company, but as an irreplaceable artery of the American economy. He recognized that moving a ton of freight by rail is 3 times more fuel efficient than moving it by truck. In a future that would almost certainly be more carbon conscious and facing higher energy prices, this was a massive, durable competitive advantage. He understood that you simply cannot replicate a 32 500-mile network of tracks. The capital cost and the regulatory hurdles are insurmountable. BNSF had a moat that was literally carved into the American landscape. He wasn't betting on the next quarter's shipping volumes. He was betting that in 2020, 2030, and 2050, the United States would be a larger, more prosperous country than it was in 2009, and that BNSF would be the essential circulatory system that made that prosperity possible. It was a bet on the inevitable, and it has paid off spectacularly. BNSF has become one of the crown jewels of Berkshire Hathaway, a cash-generating machine that consistently delivers billions of dollars in profit year after year. It is the perfect embodiment of seeing the forest, the long-term, unstoppable growth of a nation, while everyone else was lost among the trees of a short-term financial crisis. This kind of financial foresight is the cornerstone of a true CEO mindset, allowing for executive decision-making that transcends the quarterly panic cycle. The reason this simple, powerful logic eludes so many smart people lies deep within our own psychology. Our brains are simply not wired to think this way. We are victims of a powerful pair of cognitive biases: scope neglect and recency bias. Scope neglect is our inability to intuitively grasp vast differences in scale. A 1% annual growth in the population seems trivial. It's a number so small it barely registers. But compounded over 50 years, a 1% growth rate results in a 64% increase in the total population. For the United States, that's an additional 200 million people, an entire second America, almost, needing food, housing, energy, and transportation. The sheer scale of that long-term change is so massive that our minds struggle to appreciate its implications. We neglect the scope of the slow, grinding forces. Compounding this is recency bias, our natural tendency to give more importance to recent events than to distant ones. The 2008 financial crisis was dramatic, terrifying, and immediate. It dominated our mental landscape. The slow, boring fact that the U.S. population would add another 3 million people the following year felt abstract and irrelevant by comparison. Our brains evolved on the African savanna, where the immediate threat of a predator in the bushes, recency, was far more important than the long-term projection of herd migration patterns, scope. This wiring, so essential for survival then, is a profound liability in the world of long-term investing and wealth building. It causes us to overweight the importance of the latest market crash, the newest technology, or the most recent political headline, while completely underweighting the colossal, inevitable forces like demographics and resource scarcity that are quietly shaping our destiny. Buffett's genius is not that he is smarter, it is that he has trained himself to consciously override this faulty mental wiring. He deliberately ignores the salient, recent noise to focus on the boring, massive, long-term signal. So how can we, as individuals, begin to train our own minds to operate this way? We can start by using a practical mental model I call the 30-year headline exercise. It's a blueprint designed to force you out of the short term and into the world of inevitabilities. Step 1 is to identify a current data point, a trend that is so deeply embedded in the fabric of physics, economics, or human nature that it is almost certain to continue. Don't look for something exciting, look for something undeniable. Examples could be the doubling of computing power every 18 months, known as Moore's Law, or the steady increase in global data generation as more of humanity comes online, or the simple, unchangeable fact that the global population is growing and aging. Choose one of these slow-moving, boring truths. Step 2 is to rigorously extrapolate this trend 30 years into the future. Let's say we choose the exponential growth of data. Your task is to imagine it is the year 2054, and you are writing a headline for the front page of a major news publication. Based on the continuation of that trend, what would a plausible headline be? Perhaps something like, "Global data storage crisis, energy consumption of data centers now exceeds that of India, spurring geopolitical conflict over power resources." This headline feels sensational, but it is a logical, linear extension of current trends. Step 3 is the crucial part. Work backward from that future reality. For that headline to be true, what other things must also be true? What industries, companies, and technologies are the essential picks and shovels required to build that future? For our headline, the world would need incomprehensible amounts of data storage. It would need more efficient cooling technologies. It would need cybersecurity on a scale we can't imagine. And most importantly, it would need a catastrophic amount of electricity. The companies that provide these fundamental building blocks must thrive for that future to come to pass. Step 4 is to bring it back to today. You now have a list of industries, utilities, cybersecurity firms, industrial cooling manufacturers that are positioned to benefit from a powerful long-term trend. Now you can begin the traditional work of analyzing the specific companies within those sectors, looking for the ones with durable competitive advantages and reasonable valuations. This exercise systematically forces you to ignore the daily noise and connect your investment themes directly to long-term structural inevitabilities, a core practice in sophisticated asset allocation. The vast majority of investors, the 99%, follow the exact opposite path. Theirs is the path of the antithesis, the way of the theme chaser. This individual doesn't look for slow, boring certainties. They hunt for fast, exciting narratives. They hear about the revolutionary potential of artificial intelligence on a podcast, see a few stocks triple in price, and, driven by a fear of missing out, they pile in at the top. They confuse short-term market momentum with a long-term investable trend. The dot-com bubble of the late 1990s is the ultimate cautionary tale. The underlying trend, the increasing importance of the internet and digitization, was absolutely correct. It was a true megatrend. But the theme chaser didn't invest in that trend. They didn't buy the picks and shovels, the Ciscos or the Microsofts, companies building the essential infrastructure. Instead, they speculated on the hype. They bought companies like Pets.com or Webvan, businesses with flimsy models and no profits, simply because they had .com in their name. They were buying the sizzle, not the steak. They were betting on a specific popular application of the trend, rather than the trend itself. When the bubble inevitably burst, their portfolios were annihilated. The tragedy is that their initial instinct was right. The internet did change the world. But their methodology was fatally flawed. They chased the fast, popular, and ultimately ephemeral story, while ignoring the slow, boring, and ultimately profitable infrastructure that underpinned it. This is the path of the 99%, a constant, frantic search for the next hot thing, leading to a portfolio built on a foundation of sand, destined to be washed away by the first turn of the tide. The direct financial connection between Buffett's approach and the theme chasers is stark and quantifiable, and it appears most clearly in the metrics of portfolio volatility and long-term returns. A portfolio built on chasing hot themes is inherently fragile. It will exhibit a high beta, meaning it will swing more dramatically than the overall market. When the hot theme is in favor, the returns can be spectacular, providing a rush of validation. But when sentiment turns, the crash is equally brutal. It's a roller coaster of extreme highs and terrifying lows. Now consider a portfolio built on the principle of inevitability. A significant allocation to a company like BNSF or a well-run utility company that benefits from population growth creates a powerful ballast. These businesses are less correlated with the speculative whims of the market. Their earnings are tied to far more stable, predictable forces. As a result, the portfolio's volatility decreases. The ride is smoother. But does smoother mean lower returns? Over the long term, the answer is a resounding no. The theme chaser's portfolio suffers from the catastrophic collapses that wipe out years of progress. The inevitability portfolio, while perhaps not capturing the most meteoric of the upswings, avoids the devastating downturns. It just grinds higher, year after year, pushed forward by its demographic and economic tailwinds. The math of compounding overwhelmingly favors the steady grinder over the volatile gambler. A 10% annual return with low volatility will, over 30 years, create far more wealth than a portfolio that averages 12% but experiences 50% drawdowns every few years. The financial connection is clear. Ignoring the noise and investing in inevitabilities lowers risk, smooths returns, and unleashes the full, world-changing power of long-term compounding. It is the foundation upon which all sustainable wealth building rests. Having established the importance of seeing the grand, inevitable currents of history, we must now turn our attention to the most powerful of these currents, people. The second pillar of this philosophy is what we call the demographic goldmine. It is the art and science of investing in the predictable behaviors and needs of human populations as they grow, age, and move up the economic ladder. Buffett understands that economics is not just about numbers on a spreadsheet, it's about human desire, aggregated and multiplied by billions. And there is no greater story of aggregated human desire in the last century than the rise of the global consumer. The foundational anecdote for this pillar is one of Buffett's most famous and most profitable investments, a company that sells little more than sugar, water, and a powerful idea, Coca-Cola. To the casual observer, Coke is a simple beverage company. To Buffett, it was, and is, a demographic-fueled juggernaut, perfectly positioned to capitalize on one of the most significant trends in human history. In 1988, Warren Buffett invested over $1 billion to acquire a substantial stake in the Coca-Cola Company, a sum that represented a huge portion of Berkshire Hathaway's portfolio at the time. What did he see that others missed? He wasn't just looking at Coke's sales in America, he was looking at a world map. He saw billions of people in China, India, Latin America, and Africa who were just beginning their journey out of poverty and into the global middle class. He understood a simple, profound truth about human nature. As people get just a little bit of disposable income, one of the very first things they purchase is an affordable, simple pleasure. They buy a small luxury that connects them to the wider world. And no product in history has been better at delivering that feeling than a cold Coca-Cola. He famously calculated the share of mind that Coke occupied. He knew that the brand was seared into the consciousness of humanity. The key insight was linking this powerful brand to the demographic wave that was about to crest. He saw that per capita consumption of Coke in the United States was high, but in most of the rest of the world, it was negligible. This wasn't a problem. It was the single greatest business opportunity of the next 50 years. He wasn't betting on a new flavor or a clever marketing campaign. He was making a multi-decade bet that as billions of people got richer, they would want to drink Coke. It was a bet on the predictable trajectory of human aspiration. That initial $1.3 billion investment is now worth over $25 billion, not including the tens of billions in dividends Berkshire has received over the years. It is a testament to the power of demographic investing, of finding a superb business that is selling a universally desired product to a population that is growing in both number and wealth. The reason this seemingly obvious opportunity was missed by so many is rooted in another set of powerful cognitive biases, the empathy gap and the linear projection fallacy. The empathy gap describes our difficulty in imagining and emotionally connecting with situations that are vastly different from our own. For an investor sitting in New York or London in the 1980s, it was intellectually possible to know that incomes were rising in rural China, but it was psychologically difficult to feel the reality of what that meant, to truly empathize with the desires of a billion people experiencing disposable income for the very first time. The reality was too abstract, too distant. We project our own saturated, developed world experience onto the rest of humanity, failing to grasp the sheer, explosive power of a society moving from subsistence to consumption. This is compounded by the linear projection fallacy. Our brains tend to think in straight lines. We see the present and project it forward at a steady rate. We fail to grasp the non-linear exponential nature of societal change. The journey from $500 per capita GDP to $5,000 is not a simple tenfold increase in consumption. It is a phase transition. It is the moment when a society unlocks bicycles, then motorcycles, then cars, when it moves from one television per village to one per household. Buffett, unlike most, sees the world in S-curves, the classic adoption curve for any new technology or product. He understands that demographic and economic trends don't move in straight lines. They start slow, then hit an inflection point and explode with exponential growth before leveling off. His great skill is identifying a massive market at the very beginning of that steep, explosive part of the S-curve, as he did with Coca-Cola and the global consumer. This is the essence of building true, long-term wealth. To apply this kind of demographic foresight to our own investment strategy, we can use a powerful mental model called the per capita consumption ladder. This is a systematic way to identify companies poised to benefit from the same forces that propelled Coca-Cola. Step 1 is to identify a product or service that has reached high per capita consumption in developed nations, like the United States or Western Europe, but has very low penetration in a large, populous, developing nation like India, Indonesia, or Nigeria. Think of things like life insurance policies, air travel, automobiles, cosmetics, or even something as simple as chocolate consumption per person. The data is readily available from sources like the World Bank or the IMF. The goal is to find a massive gap in consumption habits between the developed and developing worlds. Step 2 is to research the economic trajectory of that developing country. You are not looking for a temporary boom. You are looking for signs of sustained, long-term growth in GDP per capita, a growing middle class, and a stable political environment that encourages investment. The trend is your friend, and you need to ensure that the economic wind is at the country's back. Step 3 is to identify the dominant, best-of-breed company in that specific sector within that country. This could be a local champion, the leading domestic bank or airline, or it could be a multinational corporation that has established a powerful beachhead and is poised to dominate the market as it grows. The key is to find the leader, the company with the strongest brand and the best execution. Step 4 is the final, crucial qualitative check. You must ask yourself a critical question. Is there any deep-seated cultural, religious, or structural reason why these 1 billion people, once they have the money, won't eventually want this product or service as much as Americans or Europeans do? For something like Coca-Cola or an iPhone, the answer is generally no. The desire is universal. For other products, the answer might be more complex. If you can find a product with a huge per capita consumption gap, in a country with a strong economic tailwind, being sold by a dominant company, and for which the desire is fundamentally universal, you have found a potential demographic goldmine. You have aligned your capital with the powerful current of human aspiration. The antithesis to this global, demographically aware approach is a portfolio management mistake that is tragically common. It is the path of the domestic bubble. This is the investor whose portfolio is 90 or even 100% allocated to companies in their home country. This isn't born of sophisticated analysis. It's born of familiarity. It's a classic home country bias. We invest in what we know, the companies we see every day. For an American investor, this means a portfolio loaded with U.S. stocks. While the U.S. market has been a fantastic place to invest for a long time, this approach creates a dangerous and unnecessary blind spot. It willfully ignores the single greatest growth story of the 21st century: the economic ascent of billions of people in the developing world. The ultimate cautionary tale for the domestic bubble investor is Japan. In the 1980s, the Japanese stock market, the Nikkei, seemed unstoppable. Japanese investors, flush with cash and brimming with national pride, piled their life savings almost exclusively into domestic stocks. They believed their own economic miracle was the only story that mattered. Then, in 1989, the bubble burst. What followed was not a quick recovery, but a brutal, grinding bear market that lasted for more than 2 decades. An entire generation of Japanese investors who were trapped in their domestic bubble saw their wealth evaporate. They experienced the infamous lost decades. Meanwhile, during that same period, explosive growth was happening in China, South Korea, Brazil, and India. The rest of the world was moving on. The domestic bubble investor, by limiting their opportunities set to their own backyard, not only misses out on the world's most dynamic growth, but also exposes their portfolio to the catastrophic risk of a single-country economic stagnation. Demographic investing is, at its core, a tool for diversification, not just across industries, but across the great sweep of human progress. The financial manifestation of demographic investing is simple and profound. It dramatically expands a company's total addressable market, or TAM, and extends its runway for growth. Think about it in concrete terms. A company that sells a product only to the 330 million people in the United States, a mature and slow-growing market, has a natural ceiling on its potential. Growth must come from taking market share from competitors or incremental innovation. Both are difficult and expensive. Now consider a company selling a universally desired product to a potential market of 5 billion new consumers in Asia, Africa, and Latin America. Its TAM isn't just bigger, it's orders of magnitude larger. The runway for growth isn't 5 or 10 years, it's 50 or more. This has a direct and powerful impact on how you value a business. In any discounted cash flow model, a key input is the long-term growth rate. For a company limited to a mature domestic market, you might pencil in a growth rate of 2 to 3% per year in line with GDP. For a company tapping into the demographic goldmine of the emerging global middle class, a sustained growth rate of 10 to 15% for decades is not just possible, but plausible. A higher, more durable growth rate mathematically translates to a much higher intrinsic value for the business today. This is the financial secret. The demographic tailwind doesn't just make a company's profits grow, it fundamentally increases what that company is worth right now. By learning to see the world through a demographic lens, you gain a unique advantage, allowing you to identify companies whose true, long-term value is systematically underestimated by a market obsessed with the next quarter's results in their own backyard. Once we understand how to harness the slow, predictable trends of demographics, we must turn to an even more fundamental force, a trend rooted not just in human desire, but in the laws of physics and the non-negotiable requirements of civilization itself. This brings us to our third pillar, the unquenchable thirst. This is the principle of betting on the essential, non-negotiable needs of a growing and advancing society. It is about investing in the things our world simply cannot live without. And at the top of that list, the absolute foundation of all modern progress is energy. Warren Buffett's multi-decade foray into the energy sector, culminating in the creation of the corporate behemoth now known as Berkshire Hathaway Energy, is the ultimate case study in this principle. This was never a short-term bet on the price of oil or natural gas. It was a long-term structural bet on a fundamental truth: human progress requires power. Starting in the late 1990s, Berkshire Hathaway began acquiring regulated utility companies, starting with Mid-American Energy and later adding Pacificorp in a multi-billion-dollar deal. To many on Wall Street, these were, once again, boring, slow-growing businesses. They were capital-intensive and heavily regulated. But Buffett saw them not as simple electric companies, but as the toll booths on the road to the future. He looked at the coming decades and saw a series of undeniable trends, all pointing in one direction: a massive, sustained, and non-negotiable increase in the global demand for electricity. Consider the forces at play. The digital revolution, which was just getting started, required data centers. And data centers are nothing more than giant, power-hungry warehouses. The rise of the internet, cloud computing, and now artificial intelligence are all, at their most basic level, functions of electricity consumption. At the same time, the demographic wave of a rising global middle class meant billions of people wanting refrigerators, televisions, and, most importantly, air conditioning. And looking further ahead, the necessary transition to a greener economy meant the electrification of transportation, millions of electric vehicles all needing to be plugged into the grid. Buffett realized that regardless of which software company won the AI race, which car company dominated the EV market, or which website captured the most eyeballs, they would all need one thing: more electricity. He was not trying to pick the winner, he was buying the entire racetrack. By acquiring regulated utilities, he was purchasing businesses with guaranteed returns, high barriers to entry, and a demand profile that was locked into the very structure of future progress. It was a bet on the unquenchable thirst of humanity for a better, more electrified life. The psychological principle that allows Buffett to see this so clearly while others chase more glamorous investments is his mastery over salience bias. Salience bias is our tendency to focus on things that are more prominent, emotionally striking, or easier to imagine, while ignoring things that are less remarkable, even if they are more important. The new iPhone is salient. The sleek design of a Tesla is salient. The seemingly magical capabilities of an AI chatbot are salient. These things capture our attention and our imagination. The boring gray utility pole outside your window, the high-voltage transmission lines stretching across the countryside, the nondescript natural gas power plant humming away 20 miles from town. These things are the opposite of salient. They are invisible infrastructure, and we take them for granted. The average investor, a victim of salience bias, gets excited about the sexy applications of a trend. They want to own the AI software company, the EV car manufacturer. Buffett, having conquered this bias, instinctively asks a more fundamental question: what has to be true for this entire future to exist? And the answer, almost every single time, is more energy and more infrastructure. By deliberately turning his attention away from the flashy endpoint and toward the boring, essential foundation, he positions his capital to profit from the entire trend, not just a single, high-risk application of it. He is insulated from the brutal competition among the high flyers and instead owns the indispensable platform upon which they all compete. To cultivate this way of thinking, we can employ a mental model called the dependency stack. This is a process for deconstructing a popular trend to find the non-negotiable, foundational investment opportunities hidden within it. Step 1 is to take any major technological or societal trend that the media and market are excited about. Let's use artificial intelligence as our example. Everyone agrees it is the future. Step 2 is to resist the urge to immediately look at the top-level companies, the ones creating the AI models and software. Instead, your task is to map out the entire dependency stack that sits beneath them. Ask yourself, what do these AI companies absolutely, fundamentally depend on to function? Step 3 is to move systematically down that stack. AI software requires massive amounts of computing power. Where does that come from? It comes from specialized semiconductors, like GPUs, and from vast data centers. Okay, so now we have two more layers: chips and data centers. What do data centers depend on? They need an incredible, almost unbelievable amount of electricity to run the servers, and they need equally massive cooling systems to prevent them from overheating. So now we have electricity and industrial cooling as our next layers. And what does the electricity grid itself depend on? It needs power generation, natural gas, solar, wind, nuclear, and it needs transmission and distribution infrastructure to get the power to the data center. Step 4 is to analyze the investment potential at the bottom of the stack. Look at the regulated utilities that will supply this power, the industrial companies that build the cooling systems, the engineering firms that construct the transmission lines. These companies are often far less glamorous, trade at more reasonable valuations, and are beneficiaries of the entire *AI trend, regardless of which specific AI company ultimately wins the software war. Using the dependency stack model shifts your focus from speculating on the winner to investing in the universal enablers, turning a high-risk gamble into a high-certainty investment theme. The antithesis of this foundational approach is the path of the winning horse picker. This is the investor who, seduced by the excitement of a new technology, believes they can identify the one company that will emerge victorious from a crowded and chaotic field. They see the explosion of EV startups and try to guess which one will be the next Tesla. They see dozens of biotech companies racing to cure a disease and try to pick the one that will get FDA approval. This is not investing. It is a form of gambling. The history of technology and business is littered with the corpses of early pioneers. In the early 1900s, there were over 250 automobile manufacturers in the United States alone. A winning horse picker would have had to sift through all of them to find Ford or General Motors. The odds were astronomically against them. The vast majority went bankrupt. The truly smart money at the time wasn't betting on a specific car company. It was betting on the unquenchable thirst for mobility. It was investing in the companies that supplied the steel for the frames, the rubber for the tires, and, most famously, the oil and gas that made them run. John D. Rockefeller became the richest man in the world, not by building the best car, but by supplying the fuel for all of them. The winning horse picker takes on massive, uncompensated risk by trying to predict the unpredictable outcome of a competitive melee. The foundational investor, by focusing on the non-negotiable inputs, profits from the entire race, regardless of which horse crosses the finish line first. The direct financial connection of this principle is that it leads you to businesses characterized by inelastic demand and enormous barriers to entry. Inelastic demand means that customers need the product regardless of the economic climate. People and businesses may cut back on luxury goods during a recession, but they do not turn off their electricity. This creates an incredibly stable and predictable stream of revenue for a utility company. Furthermore, these foundational businesses often operate as regulated monopolies or oligopolies. You cannot simply decide to build a competing electricity grid or railroad network. The capital requirements and regulatory approvals create a nearly insurmountable moat that protects the incumbent business from competition. This unique business model, a government-sanctioned monopoly selling a product with inelastic demand, is a recipe for predictable, low-risk cash flow. On a company's financial statements, this translates into consistent revenue growth, stable profit margins, and the ability to pay out a significant portion of earnings as dividends. This reliable dividend stream provides a steady return to investors, while the company's massive, regulated asset base allows it to reinvest capital at a guaranteed, reasonable rate of return. A portfolio anchored by these toll road businesses is a fortress of stability. It becomes the bedrock of a conservative, wealth-building strategy, providing the financial and psychological security needed to weather market storms and stay invested for the long run. Now that we have explored the macro forces of demographics and the foundational needs of civilization, we must zoom in on a more subtle yet equally powerful element of long-term investing. How do some companies not only survive but thrive through decades of change, navigating these massive trends more skillfully than their rivals? The answer often lies in an intangible asset, a powerful force that exists only in the minds of consumers. This brings us to our fourth pillar, the brand as a moat in a changing world. This is the recognition that in a world of overwhelming choice and complexity, a trusted brand is one of the most durable competitive advantages a business can possess. It is the enduring power of habit and reputation. And for the quintessential example, we must look at Buffett's investment in a company many thought he understood the least: Apple. When Berkshire Hathaway began accumulating a massive position in Apple in 2016, many market observers were stunned. Buffett had famously avoided technology stocks for decades, claiming they were outside his circle of competence. But his investment in Apple was not a sudden conversion to a tech-centric worldview. He wasn't buying Apple because of its next-generation processor or its innovative software. He was buying it for a reason he understood intimately from his decades of experience with companies like Coca-Cola and See's Candies. He was buying the single most powerful consumer brand on the planet. He saw that the iPhone was no longer just a piece of hardware. It had become the central, indispensable hub of modern life. It was the user's wallet, their camera, their primary communication device, their entertainment portal, their navigator. He understood the immense stickiness of the Apple ecosystem. Once a consumer was locked into the seamless integration of the iPhone, the Mac, the Apple Watch, and iCloud, the cost and hassle of switching to a competitor became enormous. But even more powerful than these technical switching costs was the psychological moat built by the brand. Apple, through decades of brilliant marketing and product design, had cultivated a brand associated with quality, simplicity, and status. In a 2020 interview, Buffett explicitly stated that he viewed Apple not as a tech stock, but as a, quote, consumer products company. He saw it as America's third-largest business, but one that happened to have a product that was intertwined with people's lives on a level that even Coca-Cola couldn't dream of. He was betting that this powerful brand and its locked-in ecosystem would allow Apple to navigate future technological shifts and continue to profit from the long-term, unstoppable trend of digital integration into every facet of human existence. The underlying psychological principles that make a brand so powerful are cognitive ease and the halo effect. Our brains are, to put it bluntly, inherently lazy. They are constantly seeking to conserve energy. Making decisions is metabolically expensive. A strong, trusted brand acts as a powerful mental shortcut, saving us the cognitive effort of researching, comparing, and choosing among dozens of options. This is cognitive ease. When you're thirsty, reaching for a Coke requires no thought. When you need a new smartphone, choosing the latest iPhone is the path of least resistance for hundreds of millions of people. This mental automaticity is a priceless asset. The halo effect builds on this foundation. This is a cognitive bias where our overall impression of a person, or in this case a brand, influences our feelings about their specific traits or products. Because we have a positive association with Apple due to the quality of the iPhone, the halo, we are automatically predisposed to believe that the Apple Watch, Apple TV Plus, and Apple's future ventures into finance or automobiles will also be of high quality. We transfer our trust from one product to the entire brand ecosystem. Buffett understands that in an increasingly noisy, complex, and choice-filled world, this mental real estate, the small piece of a consumer's mind that a brand occupies, is the most valuable and defensible asset a company can own. It allows a business to transcend the mere features of its products and build a lasting, emotional connection with its customers. How can we as investors identify companies with this kind of powerful intangible moat? We can use a simple but profound mental model called the pricing power test. It is a thought experiment designed to cut through the noise and reveal the true strength of a brand. Step 1 is to identify a company with a strong, well-known brand. This could be anyone from Nike to Starbucks to Disney. Step 2 is to conduct the thought experiment. Ask yourself, if this company announced tomorrow that it was raising the price of its flagship product or service by 10%, what would happen? Step 3 is to honestly analyze the potential customer reaction. If your immediate answer is, well, most of their loyal customers would grumble and complain, but ultimately they would pay it, then you have identified a company with true pricing power. This pricing power is the tangible evidence of a powerful brand moat. However, if your answer is, a significant number of their customers would immediately flee to a cheaper competitor, then the brand is weak and likely based on price, not loyalty. Step 4 is to dig deeper and analyze the source of that pricing power. Is it built on years of habit, like a morning coffee from Starbucks? Is it based on status and aspiration, like a Louis Vuitton handbag? Is it rooted in a powerful ecosystem with high switching costs, like Apple? The more durable and multifaceted the source of the pricing power, the stronger the moat and the better the long-term investment. This simple test forces you to look beyond the numbers on a balance sheet and assess the qualitative, psychological strength that truly separates great businesses from good ones. This is crucial for any entrepreneur or CEO to understand about their own business model. The antithesis to this brand-focused approach is the path of the price-based shopper. This is the investor who operates solely in the world of quantitative metrics. They screen for stocks with low price-to-earnings ratios or low price-to-book values, believing that cheapness is the ultimate virtue. In doing so, they systematically ignore the immense, unquantifiable value of a great brand. They will buy the generic no-name cereal manufacturer because it looks cheaper on a spreadsheet than General Mills. They fail to understand that the company with the brand, with the pricing power, can consistently command higher profit margins, generate more free cash flow, and is far more resilient during economic downturns when consumers flock to trusted names. The classic example of an industry where this mindset leads to ruin is the airline industry. For decades, Buffett famously and vocally detested airline stocks. Why? Because it is a largely commoditized business. For most travelers, the decision of which airline to fly is based almost entirely on two factors: price and schedule. Brand loyalty is virtually non-existent. This lack of pricing power leads to brutal, cutthroat competition, chronic unprofitability, and a long history of bankruptcies. The price-based shopper, looking at a struggling airline's low stock price, might see a bargain. Buffett, applying the pricing power test, sees a fundamentally broken business model with no sustainable competitive advantage. This distinction is the difference between value investing and simply buying cheap, low-quality assets. The direct financial connection between a strong brand and superior business performance is most clearly seen in a key metric: return on tangible capital employed, ROTC. Imagine two companies that both earn $100 million in profit. Company A, a heavy industrial manufacturer, had to invest $1 billion in factories and machinery to generate that profit, a 10% return on tangible capital. Company B is Coca-Cola. Its profit is generated not by massive physical assets, but by the brand equity built up over a century. It might only need $100 million in tangible capital, bottling plants, etc., to support its operations, generating a 100% return on tangible capital. The brand is a massive, valuable asset that doesn't even appear on the balance sheet. A business with a high ROTC is a financial marvel. It is a capital-light compounding machine. It can grow its earnings without having to constantly pour money back into expensive new equipment. This frees up an enormous amount of cash flow. This cash can then be used to pay dividends to shareholders, buy back its own stock, making the remaining shares more valuable, or make strategic acquisitions, all without taking on a single dollar of debt. This ability to self-fund explosive growth is the financial engine that turns a good company into a legendary investment, creating a virtuous cycle of ever-increasing shareholder value. We have now journeyed through the external forces that shape our world: the slow march of inevitability, the powerful currents of demography, the unquenchable thirst for essentials, and the intangible power of brands. But none of this knowledge matters without the final crucial element. It is the active ingredient that catalyzes all the others, the one that transforms a brilliant strategy on paper into a life-changing fortune in reality. This is our fifth and final pillar: the compounding of certainty. This is the recognition that the greatest arbitrage opportunity available to the individual investor is not in information or analysis, but in temperament. It is the discipline of patience, the ability to hold on through thick and thin, to allow the undeniable trends you've identified to play out over not years, but decades. The greatest illustration of this principle is not one of Buffett's multi-billion-dollar acquisitions, but a small, simple, and utterly perfect business he bought in 1972, See's Candies. In 1972, Warren Buffett and Charlie Munger purchased See's Candies, a beloved West Coast chocolate maker, for $25 million. By conventional metrics at the time, they were overpaying, but they saw a business with a fanatical customer base and, critically, the pricing power that comes with a cherished brand. See's was a good but not spectacular business. It wasn't going to grow at 30% a year. Its magic was not in its growth, but in its durability and its ability to generate cash. The key to unlocking its incredible potential was not some brilliant strategic overhaul. It was doing almost nothing at all. Buffett and Munger simply let See's continue doing what it did best. They allowed the business to slowly raise prices year after year, a little bit more than inflation, which customers happily paid because of their loyalty to the brand. They took the profits the business generated, cash that wasn't needed for new factories or massive capital expenditures, and reinvested that money into other great businesses within Berkshire Hathaway. Now consider the result. That initial $25 million investment, a business that they have held for over 50 years, has since generated more than $2 billion in pre-tax earnings for Berkshire. $2 billion from a $25 million purchase without requiring significant additional capital investment. See's Candies is the ultimate case study in the power of buying a wonderful business, powered by the simple trends of population growth and inflation, and then having the superhuman patience to let it compound for half a century. It is the financial manifestation of a snowball rolling down a very long hill, gathering mass and momentum with every single turn. The reason this simple act of holding on is so difficult for most people is due to a deep-seated psychological flaw known as hyperbolic discounting. This is our brain's powerful innate tendency to prefer smaller immediate rewards over larger later rewards. We are wired for instant gratification. Given the choice between receiving $10 today or $15 in a month, most people will take the $10 today, even though the latter option represents a staggering monthly return. In investing, this bias is disastrous. It creates an irresistible urge to do something. We want the thrill of a 20% gain on a speculative stock this month, even if it means sacrificing the near certainty of a 10,000% gain over 30 years on a boring, high-quality business like See's Candies. Patience is psychologically painful. The market's daily fluctuations provide a constant stream of stimuli that trigger our fight-or-flight responses. Holding a stock that is down 20% feels like a tangible loss, an immediate threat. The abstract concept of its long-term potential feels distant and unreal. Buffett's ultimate advantage, his true superpower, is his almost inhuman ability to override this deep-seated, powerful human impulse. He is a master of delayed gratification, capable of sitting still and letting the magic of compounding do its work uninterrupted for decades. To build this psychological muscle of patience, we need a practical tool, a commitment device that forces us to adhere to our long-term strategy. I call this mental model the portfolio time capsule. Step 1 is to apply the principles from our first 4 pillars. Identify a small portfolio of 5 to 10 wonderful companies that are riding the kinds of undeniable, multi-decade megatrends we have discussed. These are your long-term champions. Step 2, and this is the most important part, is to get a physical piece of paper and, for each company, write down in a single sentence why you are buying it, focusing exclusively on the long-term trend. For example, I am buying this utility company because the global demand for electricity to power data centers and electric vehicles is a non-negotiable, multi-decade tailwind. Or, I am buying this consumer brand because the rise of the middle class in Southeast Asia will create 500 million new customers for its products over the next 20 years. Step 3 is to place this piece of paper into a physical envelope. Seal it. On the front of the envelope, write with a thick marker, "Do not open for at least 5 years." Store it somewhere safe. This simple physical act creates a powerful psychological barrier. It transforms your investment from a flickering number on a screen into a deliberate, long-term commitment. Step 4 is the execution. The next time the market panics, the next time the headlines are screaming about a recession, and you feel that overwhelming gut-wrenching urge to sell everything, you are forbidden from touching your portfolio until you retrieve that envelope, break the seal, and reread your original thesis. You must then ask yourself one question. Has the 30-year megatrend I identified been fundamentally and permanently broken by this week's news? In 99.9% of cases, the answer will be a resounding no. A stock market crash does not stop people from aging. A recession does not halt the world's need for more electricity in the long run. This process forces a moment of deliberate, rational reflection, short-circuiting the panic response and allowing you to stay the course. The antithesis to this patient, long-term approach is the path followed by the overwhelming majority of market participants. This is the path of the gardener who keeps pulling up the seedlings. This individual may do all the hard intellectual work. They might identify a wonderful company riding a powerful trend. They buy the stock, and it goes up 30%. Pleased with their cleverness, they sell it to lock in a profit. Or, perhaps after they buy, the market has a correction and the stock goes down 20%. Fearing further losses, they panic and sell to cut their losses. In both cases, they have committed the same cardinal sin. They have interrupted the process of compounding. They have planted a healthy seed in fertile soil, but they keep pulling it up to see if the roots are growing, never allowing it to mature into the giant oak tree it was destined to become. Academic studies have shown, time and again, that the stock market's long-term returns are not delivered in a smooth, linear fashion. They are concentrated in just a handful of incredibly powerful days. If you are constantly trading in and out of the market, trying to be clever, the probability that you will be on the sidelines during those crucial, explosive up days is incredibly high. By pulling up your seedlings, you not only miss out on the long, slow growth, you almost guarantee that you will miss the very moments that generate the vast majority of all wealth. The direct financial connection of this final pillar is the very mathematics of wealth itself. It is the eighth wonder of the world, as Einstein supposedly called it, compound interest. The numbers are so dramatic they can be difficult to fully comprehend. Let's take a simple example. A $10,000 investment that grows at a healthy 10% per year will be worth $25,937 after 10 years. A nice return. But the magic hasn't even started yet. After 20 years, it's $67,275. After 30 years, it's $174,494. And after 40 years, it's a staggering $452,592. Notice the pattern. The growth in the first decade was about $16,000. The growth in the fourth decade alone was over $278,000. The overwhelming majority of the wealth is created at the end of the journey. This is the iron law of compounding. When the gardener sells after a few years to lock in a small profit, they are not just forfeiting some future returns. They are forfeiting the entire exponential phase of wealth creation. They are trading a life-changing fortune for a small, fleeting taste of being right. Patience is not just a virtue in investing, it is a mathematical necessity. It is the final, indispensable gear in the machine of financial freedom. Without the discipline to hold on, all the brilliant analysis of trends and moats becomes little more than an interesting academic exercise. With it, it becomes the engine that can transform a modest sum of capital into true, generational wealth. You have just been given the blueprint for trading short-term speculation for long-term certainty. You have learned to see the world through a new lens, to identify the slow-moving, inevitable trends that shape our future, and to find the businesses that are built to profit from them. This is more than just an investment strategy. It is a powerful mental tool for making decisions in a complex world. But identifying a trend is only the first step. The true masters of this game, like Buffett, understand that these long-term currents are interconnected. The demographic shift of an aging population powers the need for new healthcare solutions. The brand moat of a powerful company protects it as it navigates the trend of global economic change. It's a complex, interwoven system of mental models, each one strengthening the others. And the video that is now on your screen is designed to give you the next piece of that map. It is the critical link that connects the what with the when. It reveals the specific catalysts and valuation triggers Buffett looks for before he commits billions of dollars to one of these megatrends. It's about knowing not just that a storm is coming, but precisely when to raise the sails to catch the wind. Most people will click away now, satisfied with the powerful ideas they've just acquired. But for those of you who are serious about building a true arsenal of mental models, for those who see this not as entertainment, but as essential education for your financial future, the path forward is clear. The decision to click is not about watching another video. It is a declaration that you are committed to completing the system. It is the next step in your ascent. Continue the journey.